SIRC of ICAI. I welcome you all to the today's program SME Finance Insights 2025. I now welcome Mr. Jagadeesh Balu onto the dais. I also request the members to stand up for the ICAI anthem.
येष सुप्तेषु जागृति येष सुप्तेषु जागृति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यति कश्चन एतद्वैता 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 एतद्वैता.
Okay, thank you. Today we have Mr. Jagadeesh Balu with us. With over 13 years of experience in investment banking, corporate finance and capital markets, Jagadeesh Balu sir is the foundation of Prudent Capital, a boutique advisory firm that provides strategic and financial solutions to startups and SME. Prior to launching Prudent Capital, he was a founding member and head of co-lending at UB, a Fintech platform that enables affordable and accessible credit to underserved segments. Therefore, he worked with multiple lenders, partners, and regulators to design and execute innovative and scalable co-lending models. Before that, he was an associate director at Northern Arc Capital, a leading non-banking financial company that facilitated debt financing for high-impact sectors. His core competency include deal origination, structuring, valuation, negotiation, and execution, as well as market research, financial analysis, and risk management. On behalf of SIRC, we thank you for accepting our invitation, sir. I would like to request C.S. Soundarajan sir to present a memento to our today's speaker. Yeah, I now invite Mr. Jagadeesh Balu to connect the program. Thank you, sir.
Left, right. Thanks for the introduction, sir. I'll take a quick couple of minutes in introducing myself again. I was born and brought up in Tirupur. Did my engineering from College of Engineering Gindi, Anna University. Actually, on the 12th வரைக்கும் நல்லா பண்ணேன். College of Engineering போனோடனே ஒரு first 1 monthலேயே தெரிஞ்சிருச்சு. I should have been, I am not an engineer, I should have been something else. அந்த something elseங்கிறது கொஞ்ச நாள் போனதுக்கப்புறம் தான் புரிஞ்சுது. I am a numbers person, I should have been a CA. Right, CAங்கிறது it's something which is my dream which has never come true. But somehow, thankfully now I am addressing an audience of CAs. So did my engineering from College of Engineering Gindi, then did my MBA from IIM Lucknow, 2008-2010 batch. Then I also completed CFA and FRM courses. Had a 13-year stint in corporate. Started out with Axis Bank in Bombay. Then moved to Chennai to an investment bank called SPARC Capital, where I was there for 3 years doing end-to-end deal making in equity investment banking. அதுக்கப்புறம் வந்து Northern Arc ஒரு entity NBFC க்கு மூவ் பண்ணேன். Then from there I moved to another organization called Vivriti Capital, where I was a founding member, day one employee and a founding member. It was a fintech which was set up by my boss who was part of Northern Arc. அவர் வெளியில வந்து ஸ்டார்ட் பண்ணாரு. Then I joined him on day one. In a span of 5 years, it became a unicorn, about 9,000 crores valuation. From 0 to 1,500 employees. I was able to see a good amount of scale being built in that 5 years. that gave me a very good experience of how organizations are built up and scaled. What are the challenges which come in scaling an organization? அது வந்து அந்த 5-year phase gave me a good experience. End of 5 years, had some ESOPs, liquidated the ESOPs, stepped out, started my own firm, which is a debt advisory firm, and slowly converting into a consulting firm as well, which is Prudent Capital. Been in this journey for 2.5 years. I was very clear that I'm not going to raise any equity for this firm. I'll run it in a bootstrap manner. 2.5 years, built a 20-member firm with offices present in 6 different locations. This is brief about me. See, Indian credit market, so Indian banking system has been existing for the last 100+ years, but compared to the global economy, our market is still very much underpenetrated. If you compare, let's take China versus Japan versus USA and other markets, both in terms of debt to GDP, we are far behind. And even in terms of credit debt penetration compared to both in household terms as well as in corporate terms, it's significantly lower. So in terms of debt penetration, we have a significant way to go. If you see, large part is still through informal sources. 85% is still through informal sources. While fintechs have come, I have a detailed presentation around fintechs later in the presentation. But while fintechs have come in, banks are moving to newer methodologies of evaluation. But still, 85% is informal sources of borrowings, which are at anywhere between 30% to 70% rate of interest. Right, that's where we are operating as an economy, and that is one of the key reasons, one of the main reasons. If you take any of the entrepreneurs, why they struggle, SME entrepreneurs, 2 reasons. One is the team and the build-up of the team. Second is capability, the funding capability. Right, now while equity has deepened in the country in the last 15 years, private equity has come in, VC has come in, but that is accessible for a limited few. Right, similarly, debt. The questions around, lot of traditional questions come, which I have touched upon, right? So debt is not easily available for anybody and everybody. In terms of breakup, if you see, banks still constitute a very major portion of the debt, but there are other segments which are catching up. NBFCs nalla fast grow aayittu irukanga. Last 10-15 years la NBFCs has taken a decent share. And alternate investment funds are coming up, which has taken a decent share, about 2%. Mutual funds are also picking up, and the wallet of retail as well as institutional investors are going into mutual funds. So the mix is changing from banks to the other segments as well. This is a scenario in the last 10 to 15 years. See, this is an article which I was seeing in LinkedIn yesterday. Now, this is about one of the founders. He had lamented saying that India on the credit score 700 kammiya irundha loan is not possible, right? And he had met a promoter who was 500 credit score, CIBIL score, and on the avarnal loan edukka mudiyala 18 masathukku. The only issue was that before 18 months he had one due, right? And the oru EMI katta muttadunala his CIBIL score is 500, and CIBIL score decides everything in this country, right? Credit score decides. So this person, whoever he is referring to, he cannot raise debt. So a lot of assessment is unilateral in nature, single parameter or parameterized still in our country. In fact, I just pulled out one of the videos from a movie. Just a minute, just to showcase 30 years back versus today, how is the system, and it all remains the same. Nothing much has changed.
இவர் என் ஃப்ரெண்ட் அண்ணாமலை. இவருக்கு லோன் வேணும் சார்.
என்ன பிசினஸ் பண்ண போறீங்க?
மாடு வாங்கி பால் வியாபாரம் பண்ண போறோம்.
எவ்வளவு பணம் வேணும்?
2 லட்சம்.
அண்ணாமலைக்கு சொந்தத்துல வீடு இருக்கா?
வீட்டைத்தான் இடிச்சிட்டானுங்களே.
நிலமாவது இருக்கா?
நிலத்தையும் தான் அந்த படுபாவிங்க மோசம் பண்ணிட்டானுங்களே.
என்ன சார் இது? வீட்டை இடிச்சிட்டாங்க, நிலத்தை மோசம் பண்ணிட்டாங்கன்னு சொல்லி லோனை வாங்கி யார மோசம் பண்ண பாக்குறீங்க? ப்ளீஸ் கெட் அவுட்.
டோன்ட் சே கெட் அவுட். we are citizen of India.
அப்போ தயவு செய்து வெளியில போறீங்களா?
This was 30 years back, Annamalai Padam. Today, you go to a traditional bank, these are the questions still being asked. What is the collateral and how are your financial metrics? Still the ecosystem is not very fully evolved, while government is doing a lot of things, and I have a lot of slides around what are the government schemes. But if you go as a traditional entrepreneur, go in front of a branch manager and ask with your financials, ask for a loan. The first question asked is, what is the collateral, what are the assets in your name to finance? Cash flow is secondary actually, right? How much cash flow you are making, what is the business? Those things are secondary, whereas collateral is still given a very primary importance in a traditional bank. What do you think are some of the pain points in Indian MSME lending? I mean, இன்னைக்கு raise பண்றதுல, I mean, most all of your CAs, and where do you face challenges?
Second or third priority. There may be some reason, but that is a first point. MSME is not having, they are not giving first priority to MSME bank. Second one, MSME may be highly strong in terms of infrastructure and all, but they may not have enough strength or enough guts to explain what our strength. Got my point, what I am trying to say. As a MSME, suppose I am going to start one industry, I may be highly knowledgeable. But at the same time, whether I am able to explain my strength, that is a big question. So that we are approaching the consultant, right? Consultant, nothing but they will have all from outside, then they will furnish, right? That is the one thing, okay? Because MSME is mainly depending on consultant. So that also, because that cost, that may be additional cost to MSME. That is borrowing cost will be enhanced accordingly. Third one, as per my understanding, MSME, okay, has to prove their role as vital player of economy. Nowadays, they are trying to prove, but they are yet to prove whether we are able to play vital role in overall growth of economy. That is one reason. They are not proving that point. This is the 3 points I have in mind.
Absolutely, bang on. Anybody else? Any other points? I mean, these are some of the reasons. I mean, from a one documentation perspective, right? All the numbers may not be shown on the papers as to what they are really making, and always belief is that larger the entity, better it is. As sir rightly pointed out, 85% of the loans today from the credit system is given to the top 500 entities, while there are 6 crore MSMEs in the country. 500 entities take 85%. I used to be part of large corporate in Axis Bank. The sanctions used to be in 500s of crores, right? That's what we used to do back in 2010 to 12. That size should have increased significantly by now. Whereas at the MSME branches today, I'm seeing that even for a 50 lakh, 20 lakh, 1 crore, it's a challenge, right? You'll have to go through that entire 1 month, 1.5 month, 2 month cycle to get a loan through. So banks believe towards the MSMEs and the ability of the promoter to pull it off as an idea, or as a crore or 2 crore, 3 crore of entity to kind of come up to the next stage, because the mortality rate is also high in this segment. Till you reach a 10 crore level, you may either stagnate there or you might fail. Hence, banks are very conservative when it comes to lending to this segment, and all the numbers are not showcased. So some of the critical parameters bank look at it: credit score and business story. Who is the founder? What is his background? What is his CIBIL? This. I mean, I always say 3 pillars to lending. One is the cash flows. What is the business making? What is the projection? How do you kind of come up in terms of stack up in terms of numbers? Then what is the promoter background, and what is the collateral? These are the 3 pillars with which a loan is given. Now, if certain numbers are not stacking up, are there work orders to justify a project, right? Now, some of the parameters: CIBIL, bank statement, financial statement, GST, work order. Now, credit. credit rating. Now again, if it's a mid-sized company, credit rating plays a very critical role, whether it's a double B, triple B, double A, triple A. Now, if these numbers are there, lenders are very confident of lending, and about, as I told you, 85% of the loans are given to the AAA segment, and some of the large institutions in the country you might be already knowing, CRISIL, ICRA, CARE, India Ratings, Brickworks. These are the guys who are lending in the doing credit rating in the market. Now, I mean, what are the levers of credit rating? Now, levers of credit rating, this includes financials, vintage, how consistent are they in the financial performance. Sector is a very important aspect. Now, a trading entity may not be given as much weightage as a manufacturing entity compared to a service entity. Ability to protect margins, right? If you are showing consistent margins over a period of time, then the rating will kind of be stable. If the margin is volatile, then the credit rating will be an issue. So some of the key red flags in decision making include some of these things. So I have taken up 6 different products which are there in the market, right? And I'll kind of brief each one of them. These are the products which in the banks today they are lending, and a large portion of this is available in the market. The first product is called unsecured business loan, right? Unsecured business loan is given to any entity which is, let's say, given a 20 lakh, 30 lakh turnover company, as long as their CIBIL is decent, right? And they have an entity status. Now banks assess it based on the banking turnover, and the banks or NBFCs and other fintechs lend to entities, right? Now, this is a segment where, unlike the traditional banks, here no charge on the current asset is taken, right? No charge on current asset, no charge on fixed asset. It's completely unsecured in nature. No collateral, no charge on assets. So banks themselves charge a significant premium here. Banks themselves charge a significant premium here. This is done anywhere between 16% to 30% in the market today, right? It's on reducing balance basis. Now banks like HDFC Bank, Kotak Bank, and some of the larger banks assess the profitability of the company basis the ITR they do lend, and then they lend it at 16%. Whereas there are new age fintechs, including the likes of Lending Card, Kinara, Neo Growth. There are multiple names. They lend again similar assessment parameters, but they kind of take approaches like banking turnover method and GST method. Basis that they lend at 28 to 30%. Now, what is the difference? I mean, why should an entity get it at 28 to 30%? Now, let's take if an entity is of 50 lakhs turnover, they're not showing any profitability. They're showing very limited profitability, 50 lakh turnover and 2 lakh profit is what they are showing, but they want a 25 lakh loan. Now, if you go to HDFC Bank or a Kotak Bank, these banks will not fund it because they go by the traditional methods, evaluating through the financials, which is ITR. Now, whereas a NBFC, new age fintech firm, process it through proxies, right? Proxies include your turnover. If you're having a banking turnover of 50 lakhs month on month, if there is a 4 lakh turnover involved, then and there is something called as average bank balance. If you're having an average bank balance in your account, then that's a proxy to profitability, right? It may not be the real profitability, but it's a proxy to profitability. If you're having average bank balance of 1 lakh, then the assumption that the lenders take is that you'll at least have a lakh of surplus to pay EMI to the lenders, right? So this is what is called as average banking approach, which is a proxy to the real ITR approach. Now this is taken, and pricing tenor which is given here is anywhere between 1 to let's take 5 years, and largely this will be loan type nature. Okay, 1 or 2 entities are lending in the form of OD here. One of the biggest challenges which happens is that I have seen in the market is that now when promoters get in, now either they can choose between a collateral based option when they start out, let's take when they are a 50 lakh, 1 crore, 2 crore revenue, or they go with this. I've seen a lot of entities going with this. Now the challenge with this product is that it is a loan type of product. So what it does is that, and it's at high interest rate, 18 to 28%, and it's EMI based. So if you take a crore using this, if you are a 2 crore revenue entity and you have taken a crore using this,
month on month EMI will be about 3.5-4 lakhs. That puts a significant strain on the cash flows of the business. While when you're taking, see what I mean, after the interviews with a lot of promoters, discussions, I've seen that this is this product kind of, unless you are significantly profitable, right, this product actually kills the business, right? And I've seen a lot of promoters getting into this product as an initial entry point. After that, it takes them 2 or 3 years to kind of get out of this. Till then they kind of keep struggling, churning this, because month on month, whatever comes out as profit, it actually goes back as EMI, right? Because about 4 lakhs of EMI on a crore you need to pay on a month on month basis, because there is no holiday period, sir. From month 1, there will be a EMI starting. Right? This is completely unsecured in nature. There is no charge on fixed asset or charge on current assets. So a lot of entities as a starting point take this product, and one lender limits their amount of loan that they give. It is, let's take, if you take a 5 crore turnover entity to HDFC Bank, HDFC Bank will assess and say that, okay, I'll lend you 20 lakhs. But there'll be 3 or 4 lenders who will come together and they can give you 1 crore using this method. Right, a lot of entities I've seen, they have taken from 10 lenders, 15 lenders, each one of them 15 lakhs, 20 lakhs, right? So as long as the entity is profitable, this is a okay-ish approach, right? What this is better than is, this is better than a private finance approach, right? Private finance, you know, you're aware in the market, it's a 6-month or 9-month kind of loan, private financiers fund it, and upfront interest is deducted, and you kind of pay the month-on-month principal, right? This is definitely better than a private finance, but a manufacturing entity or a services entity will not be able to scale with this product. At some point, they'll get into a trap with this product. So this can be a time being or a temporary fix. If there is an urgent need for a 15 lakh, 20 lakh, 30 lakh, then this product can be availed. But if it's long-termish in nature, this is not the product to use. Some of the examples, for example, 50 lakh unsecured business loan for a 1.5 crore revenue client, 7.5 crore unsecured business loan. See, another thing is that here lenders take a deviation also. If you have some CIBIL issue in the past, right, which was about 1 year back, if your ITR is not showing complete profitability, there are lenders who take call even if there is no profitability, right? They again take proxies. There are at least 4 to 5 lenders in the market who lend even if there is zero profitability or negative profitability. Loss-making entities also get money through this. Now those are the lenders who charge a significant premium. They charge 26-27%. Lenders of the nature of let's take Kinara, Lending Card, all these guys lend at 26-27%. So those lenders are playing a high risk game. Similarly, these entities which instead of going to, let's take a venture debt or a private finance, this is a decent option. But it's not for a good, healthy, profitable company. Next one is the traditional working capital loans, which all of you would be aware. Here 25% of the turnover will be given as the loan. Again, depending upon sector to sector, we can justify a 30-35% or 40% as well. Or some of these sectors, the lenders will restrict themselves. Let's take a healthcare working capital. I mean, it's difficult to avail beyond a 10-15% of turnover. Today, CGTMSE is very prevalent, and in this budget, it has been increased from 5 to 10 crores. CGTMSE is a credit guarantee scheme by the government. Depending upon the turnover and your financial healthiness, you can take it completely unsecured in nature. Working capital can be taken unsecured in nature through what is called as CGTMSE scheme. So working capital loan, if you have a decent turnover company, let's take a 10 crore turnover company, getting a 2.5 crore loan without any security is today a possibility, right? Which probably 3 years, 5 years back was not a possibility. Government is pushing that to promote collateral free loans. And in this budget, it has been significantly increased, which is going to help the MSMEs grow. Third one is loan against property. Loan against property, see, we know the traditional loan against properties, again, we know when ITR is clean and when the property title is clean, we know you'll be able to get it from HDFC Bank and ICICI Bank. Again, there is a spectrum of lenders, starting from 8.5% rate of interest, 8.5-9% rate of interest, going as high as 22% rate of interest for a loan against property, right? Your own property is being taken and loan is lent at 22%. But these are clients who will be having a kirana store or a very I mean in a remote location, tier 2 location, and the requirement will be like 5 lakhs and the property title will not be clear. There are lenders, let's take that there's a lender called 5-star in the market who lends at 22%, right? It's a Chennai based NBFC which got recently listed about a year and a half back. So they lend at 22%. So the spectrum of loan against property is wide. As long as you have a property and the entity will be able to repay, the repayment capacity is there, then getting a loan is not a problem, right? So cash flow, collateral, if these two are there, getting from a lender through loan against property is definitely possible. So again, the loan to value ratio here can anywhere vary between 40 to 80%. For a land, lenders typically give about 40%. Property title should be clear, and rate of interest actually 8.5 to 22%, and typical tenor given is about 15 years. One of the reasons, most people take, I have seen a lot of situations where people get into a trap of personal loan. In fact, one of the, I saw recently one of my friends got into a personal loan trap. He had taken multiple personal loans, especially with these app-based loans which has come in the recent days, in the last few years. People get into the trap, and that's at a significantly higher interest rate and a short tenor. What happens is that with a 60,000, 70,000 salary, people end up taking loans which kind of take away their entire salary of the month, 60,000, 70,000, and they end up paying too large a EMI which they are not able to service. So finally what my friend did was that he had to avail a property loan. With that loan he closed all the personal loans. Now his EMI burden has come to 30,000. Right, because see, what happens is that in a personal loan, it's again at a 14 to 18% rate of interest and a short tenor. It can be anywhere between 1 to 3 years or 4 years, or rather the app-based loans are 6 months as well. In fact, one of the products which I was doing when I was in co-lending, there is a entity called Crazy Bee, which used to lend at 14 days. Right, the first product that they launched was 1,500 rupees and 14 days. There are such products in the market, right? And you'll be able to get money within 5-minute this thing of downloading the app. You'll be able to get it within 5 minutes, right? That's the level of ease with which Fintech has done money lending these days. So a lot of people get into a borrowing cycle, wrong borrowing cycle, and hence LAP is one way to kind of get them out if they are in a debt trap. Project finance. Project finance again is a function of a lot of entrepreneurs want to do a new project or they have a particular size, they have a 10 crore entity and they want to put up a very large project. Now it comes under project finance. Now few parameters again taken into consideration includes, one is promoter's experience. Now if somebody who's not in that field is coming and saying that I want to set up a 100 crore project. Now irrespective of collateral or any other factors, promoter's experience is a key thing in a lending decision, right? So if he does not have an experience, there itself it gets rejected irrespective of collateral or whatever strength you might bring in. Second thing is, does the business have a solid plan? What is the revenue mechanism? Let's take if you have a hospital, if you have a manufacturing entity, do you have a solid work order, or do you have an experience which will give you the work order? Or if it's a hospital, do you have a strong team? For example, one of the hospitals in Hyderabad that I had looked at, they had an extremely strong team from cardio to neuro to everybody. They had acquired from the Apollos of the world and other hospitals they had poached. Now those doctors were made the equity partners in this company. Right, now revenue is very clear because hospital is a business where people walk in not for the brand but rather for the doctor's name. Right, hence the first year revenue was very clear what the hospital will achieve because of the doctor's availability. So in a project finance, what is very clear, what is very important is who is the promoter, what is his background, does he have any experience with respect to that business, and what is the first year or second year, first year revenue visibility. Do you have a very clear revenue visibility? Are people willing to give you contracts? Right, some of the firms try to change from trading firm to a manufacturing firm. Now do you have clientele for that? Will you be able to sell to your clientele? As a trading, you might be importing from China and selling it, but when you're doing it, do you have the strength to manufacture at a particular pricing that you'll be able to sell it to your existing clients, right? Lot of such questions come in when you take it as a project finance. Project finance is a slightly time consuming exercise. People also don't take a call immediately. If again you back it with collateral, lenders take a comfort. Otherwise, again, for manufacturing entities or service entities, lenders do give it at lower collateral as well, anywhere between 30 to 50%. But again, it goes to layers of processing, right? When you have a lower collateral, it goes to the, let's take a GM level for approval. So it's a slightly time consuming approach when the parameters are little weak. But it's not like it cannot be done without collateral, right? A combination of through a combination of CGT MSE and other approaches, you can get a project finance also done at 30% collateral. Any questions here? See, foreign currency loans largely look at reputation of the promoter and size of the entity, sir. ECB again. That's what existing group comfort is important. If you are a large entity, okay, if you are a decent size entity or a large entity, then ECB will be given, right? But if you are an MSME and seeking for a foreign currency loan, it is difficult to achieve, right, under ECB. Right. Right. Yes. Yes, and if you have a natural hedge, right? If you are exporting and you have a natural hedge, that's a significant pricing advantage. That's right. That's right. Any other questions still here? Which ones? Okay, for project loan.
Because normally as a financeman, we know what is the ratio on leases. But if we, beyond that, banker have some kind of hidden.
No, sir. Again, see, at the end of the day, what we have seen, we have done at least 15-20 project loans. Ratios is one aspect. Now, promoters, if you are able to present a strong, as you rightly pointed out, how is the promoter able to present himself? The conviction with which he is able to present the idea. Now, at the end of the day, a project loan is all about manager's belief or a AGM's belief that promoter will be able to pull it off, right? So, the promoter's conviction in the project is experience and the work orders, right? See, the ratios are all a function of Excel sheet. We can project anything on the Excel sheet, right? So, the competition intensive, the sector in which you are getting into, right? If you are getting into, let's take, there was a tier 2 location in which we were working on a hospital. That location, the entity took about 20 crore project. Now, after assessment, the zonal office got a feedback that location may 20 crore worth of hospital if you put in, the enough revenues may not be there. That was the feedback which came through market research, right? So, this kind of market research to ensure whether a project will be sustainable at a particular level, right? Along with your promoter experience and collateral. These are the aspects which will be taken into consideration. So, there is no hard formula, at least in project finance, there is no hard formula.
Because why I am saying all this, whenever we approach a banker for first project, they are raising continuously. They are raising query based on our project, right?
Right.
Once we set right, suppose okay, first project we got trouble.
Yeah.
Whenever you approach a banker for first project, maybe 10 crore or 20 crore. Yeah. Finally, okay, based on their query and all, we are moving to other banker. You got my point. What I'm telling you. Because they are raising continuously, they are raising query. Then we move on to other banker for easy going, right?
Yeah.
That and all happening.
So what I mean, just a small this thing. What we have personally felt is that when it comes to an unsecured, okay, if you are giving a collateral, largely banks will be willing to, okay, but if you are saying, okay, I'll give a 30% collateral, now you will have to fix up a certain CGT MSE limit, right, to get the loan. Now every bank or every branch has a certain CGT MSE limit. This month I'll have to sanction 5 crores, 10 crores. They have a limit, right? Now that particular branch or that particular zone, if they are full packed in that CGT MSE limit, then they'll keep questioning you.
Correct.
Right. Now which branch is hungry for that asset, they'll sanction. Right. So these are things. See, I've also kind of come across this, experienced this. The same person who has done this in 10 days Okay, the next transaction I would have realized that he is taking 1 month to sanction. What is happening? Then over a period of time I realized his target has met and he is not wanting to kind of do that.
So to meet out their target, they are flexible.
That's
Once
right.
they meet out, then they are applying traditional method and all.
That's right, that's right. See, because at the end of the day, it's a unsecured call, right? If it's a secured call, there's no targets. They can take it at any period of time, right? If you're giving 125% security, but when you're not giving that 125% security, you're saying do it at 30% collateral, 40% collateral, then the remaining 60% is unsecured for the bank. Tomorrow anything happens on the project, it is not the promoter's risk, it's the bank's risk as well, right? So they need to take a call, they need to be very, very careful, and hence depending upon the branch target, depending upon the zone target, if the zone is already achieved its target, they may not agree even if the branch is pushing, right? Lot of such factors come into play. This is a new product which is in the market, supply chain finance, right? Traditionally banks used to lend based on your balance sheet strength, right? If the company had a balance sheet strength, now a receivable financing was done, what the typical product called bill discounting, right, was done. Now over a period of time, in the last 5 to 7 years, supply chain finance has taken the center stage, right, where okay, even though the company is small in nature, right, what if the company is supplying to a much larger entity, right? I'm supplying to let's take an Ashok Leyland, Tata Motors, or tier 2 vendors of Ashok Leyland. Now I'm supplying to somebody very credible. When I'm supplying to somebody very credible, now my strength is defined till my ability to execute the order and send it to somebody, and that somebody accepting that bill, right? Once that somebody has accepted that bill, the larger entity has accepted the bill, then the risk is not actually on me to deliver, right, as a smaller entity. Now this is called bill discounting. Now bill discounting, a lot of supply chain platforms have come in, and they are lending it, and even the NBFCs likes of Tata Capital and Aditya Birla, they have supply chain limits, and new age platforms including Credible, and there are other players who are there in the market. They go by the anchor strength, what they call as the anchor based lending. Now they have onboarded various anchors. Anchors include, let's take IOCL can be an anchor, or Tata Motors can be an anchor. Now they have onboarded that anchor. Now when you get in and tell that, okay, I am a supplier of Tata Motors, or I am a supplier of Hyundai, right? Then they immediately kind of take that bill, discount that bill, and give the money upfront to you. Not too much of assessment. Your balance sheet, the company's balance sheet, the smaller company's balance sheet does not come into play here. Now what is the catch here? One, they say that the entire money needs to be routed through an escrow account, which means that, let's take if you have supplied to Hyundai, okay, and Hyundai needs to pay you in 60 days. Traditionally you would have got in a particular account. Let's take an ICICI account, you have been getting that money, that's your OD account, and that's where you are getting your money. Now once this comes into play, once you have taken a bill discounting limit for supplying to Hyundai, now you need to have a separate account which is called a escrow account. You need to write to Hyundai saying that, okay, I've changed my bank account, right? Instead of ICICI account, you send it to SDFC account or send it to Axis Bank account. That will be the only change. They'll not know you have borrowed, or all those things will not be known. But in the front, it will be a different account, and that account will be an escrow account where the lender will have the first right of the money. Once you discount the bill, the upfront money is given to me as a supplier, right? If 100 rupees is what I am expecting from Hyundai, over the 60 days, then I'm getting my 98 rupees upfront, right? And when Hyundai gives me 100 rupees 2 months down the line, it comes into that account and it automatically goes to the lender. I don't have say over that 100 rupees, right? Now one thing to note here is that if I don't need to use this bill discounting limit, I can stop from using the limit, but the money still has to be routed through this account. Let's take one bill I am discounting. The second bill I'm not discounting, but still the cash flows through that account. But if the bill is not discounted, then automatically the 100 rupees comes to me. It does not go to the lender, right? So only on usage it is charged. Now the rate of interest here is anywhere between NBFC is charging 12%, likes of Tata Capital charging 11% to 12%, and some of the Fintech entities, lending institutions charging 18 to 19%. That's the rate of interest here. This will be on usage basis. So which means that if you are in a cycle, it will be 1.5 to 1.5% per month, right? 18% translates to 1.5% per month. So on a 100 rupee bill, you will get 97 rupees upfront for a 2-month period. So this is supply chain finance. So again, this is a good product. Instead of going to see the first product I told you, now unsecured business loan. Unsecured business loan at the end of the day is a loan. 3 years you are under that EMI trap, right? Whereas this product, while the rate of interest still is 18%, right? When you go to the fintechs, it's at 18%, but still it is pay on use basis. Hence, if you have cash flow deficit during a period, you can use this. If you are surplus on a certain period, you don't have to use this. So it fits in exactly with your requirement. It is like a hand to glove, perfect hand to glove, right? So you can use this product like that, so that while on the face of it, it might look like 18%, but because you're not using it always, the net interest which is paid out might be lower, right?
So it is limit.
It's a limit.
Unless we use the limit, okay, no need to pay.
That's right.
Okay. But normally it would be around 1.5.
It starts now the NBFCs like Tata Capital, the Tier 1 NBFCs lend at 11% for this product, right? But the thing is that they require the balance sheet of the corporate also to be somewhat decent. Only at a 50 crore entity, they'll kind of support this 25-50 crore entity.
We have charges for limit charges,
Base charges will be about 0.5 to 1%. 0.5 to 1%. Total limit.
But annual charges,
If they'll stipulate that around 70% is what you need to utilize. If you don't utilize like a OD limit, there'll be a small penalty or small additional charge, 0.2 or renewal, it will be a far lower this thing. This is something similar to OD only. Whatever sanction terms are in OD, similar sanction terms. I mean, if
nowadays all SME, whether they have to decide whether to use it this supply chain finance or working capital.
yeah.
Because working capital is a limit. Once we avail working capital, that we wouldn't have any pressure.
Yeah.
Whereas here, we will realize the pressure. Because unless we pay out the money, then it will have impact on our overall total business.
Yeah.
Here.
Yeah.
But whereas we pay out money in working capital, that wouldn't be. That would be within the four corner, between banker and
Just again, see, it's about the situation and how we structure it, sir. For example, OD,
Sorry,
you take a OD limit.
Convey, suppose I couldn't meet out the one bill under
Yeah.
process, then the opponent also, my customer also will have some kind of negativity in mind. Then
Yeah.
they wouldn't offer additional business, right?
Yeah, yeah.
That is one risk we need to notice here.
No, absolutely. That challenge is there. Now, I just also want to highlight the similar challenge is there in a OD in a different form, in a typical working capital limit. Now, you are availing a 1 crore OD, okay, justifying that I'll be a 5 crore turnover entity, right? If due to, let's say, COVID years, most entities were not able to hit the numbers, at least for 20 or 30% of the firms, OD limit was reduced. Right, OD is like a lifeline. When OD is taken over, reduced, you kind of at least these products, you know what is coming in. But in a OD or a normal working capital limit, you don't expect the working capital limit to be reduced. I mean, in my Axis Bank days, we used to call working capital limit to be like a marriage, right? Once you get in, it's permanent in nature, right? You never reduce. It only keeps increasing in nature in terms of the limit. But there are situations if your turnover reduces significantly, banker has the right to come back and reduce your limit, and that keeps happening in at least 20-30% of the entities. So that risk is always there when turnover is not met. A new product which is there in the market is this co-lending, right? This is a product, again, this is largely for retail customers. This is not for MSMEs. This is for retail customers in home loan and personal loan, unsecured business loan, a lot of products. Now, Finance Ministry has been pushing this product for the last 3 to 4 years. What is co-lending? Co-lending is a situation where a bank and a NBFC comes together to lend to a customer. Now, why should a bank and NBFC come together? Now, NBFC has different form of sourcing. right? NBFCs has new age techniques to source. As I told you, let's take there is this entity called Crazy Bee, which lends to a customer within 5 minutes 1,500 rupees, right? Or there are NBFCs which there is an entity called NBFC called Early Salary, which lends about 1 lakh of personal loan within no time, right? Using various alternate parameters. The alternate parameters can include beyond the traditional scoring parameters, including your SMSs and other factors, your salary slip and various factors which is beyond traditional. They kind of look at it and give you. Now a bank wants to wait, test the market before entering into anything, right? Whether this is scalable or not, whether this is profitable or not, they kind of want to wait, right? Hence, on a lot of these products, bank don't enter in first. Now what they are doing, they are partnering with the NBFCs. They are partnering with NBFCs and letting the NBFCs front it in terms of assessment of the customer, in terms of actual lending to the customer. They front it and banks stay at the back. This is called co-lending, right? As per the regulation, a bank and NBFC, both of them have to assess the customer. It has to be a joint assessment, right? And the credit has to be unison. Both of them have to assess the customer before lending customer. But in reality, it does not happen like that. What happens is that an NBFC assesses the customer, and both the bank and NBFC will have an agreed upon policy, right? A bank would have given the policy saying that these are the 5 parameters basis which you can kind of take a leap and you go ahead and lend. Now these 5 parameters are given or 10 parameters are given. Now the NBFC lends basis that, and the file comes to the bank. Now bank may not even give a, it will be an auto blanket approval during the initial days, right? During the month end or something, they'll see if it is fitting in with all the parameters. If it is not fitting in, they'll push back the file to the NBFC saying you take it on your books. It does not fit in with my assessment policy, right? So while the way RBI has structured this is, it has to be simultaneous evaluation, but the way practically it happens is that the first policy is given out to the NBFC lends, and then bank kind of moves ahead with it. Sorry, sir?
Funding
Huh.
would happen directly from bank.
Yes.
The NBFC will play as an intermediary.
That's right. Now here it's called co-lending. What happens is that it's not a BC model, right? There are 2 things. One is a BC model, banking correspondent. Other one is a co-lending. In a banking correspondent, somebody is acting purely as an intermediary, right? He is sourcing file for the bank, and then I'll take a step back. There is a DSA, there is a BC model, there is a co-lending. Okay, a DSA is somebody who just sources the file and gives it to the bank. He does not have any risk, right? After the file is being given. Now a BC model, now this guy sources the file, evaluates the file, and suggests to the bank that let's give to this customer, and money goes from the bank to the customer. Now this BC also has branches on behalf of the bank. Collection responsibility is taken by the BC, right? And he would also have given what is called as FLDG, first loss default guarantee, right? About 5 to 10% of FLDG he would have given. So bank realized that okay, this guy understands things, I can lend, I can partner with him and lend. Now that is BC. That BC partner may not have capital. It's a 100-0 relationship. 100 rupees, the entire 100 rupees is lent by the bank. The third approach is what is called the co-lending approach. BC has been in existence for the last 20 years, 25 years. BC model has been prevalent in India. Whereas co-lending is something which got popular in the last 3 to 4 years, right? In fact, there are various other forms of financing and NBFC. Co-lending is one of them. I'll come to other 2 approaches as well. Co-lending, NBFC and bank participate together. 80% will be financed by the bank, 20% will be financed by the NBFC. Now this combination of 80-20, now rate of interest will again, it will be a blended rate of interest. Now to the customer, it will be at a, let's take an NBFC is lending at 15%, 16%, housing loan NBFC which is lending to the rural customers or Type 2 customers at 15% or 16%. Now bank says that okay, my 80% I lend it at 10%, right? To the customer it will be still a 15% rate of interest term sheet, right? Internally, now for the distribution cost and all other cost, for 20% lending, this guy will get the what is called the excess interest, right? Out of the bank's 80%, bank has lent at 10%, but overall 100% it is at 15%. So this 80% ka 5% also comes to NBFC as a part of your sourcing cost, collection cost, all the costs involved, the distribution cost, bank, the NBFC gets it. So here both are joint at the hip. The assessment is done by the NBFC while bank approves the case, and collection again is done by taken care by the NBFC, and at the end of the month they reconcile, and the collections comes into what is called a escrow account. Again, it comes into the escrow account, and the money gets split between the principal banker and the NBFC, right? So this is actually becoming very, very popular. I think around 60,000 to 70,000 crore is the annual disbursement through this product at this point of time. It's become very popular in the last 3 years. Now what's happening is some of the largest NBFCs, including let's take IIFL or sorry Sundaram Finance or Chola, all of these guys have started doing co-lending with the banks, right? So this is exactly what I explained.
Whether the 80-20 ratio is fixed or it can be variable?
Largely from a co-lending perspective, it's 80-20, but people kind of vary it, right? So they have minimum it has to be 20% contribution by the NBFC, right? When a bank does it, they do it at 80-20. I have personally done when I was part of this UB group. We were the larger NBFC. We have done co-lending with smaller NBFCs. For example, Vruti Capital, we had a 5,000 crore balance sheet. Crazy Bee was a 500 crore balance sheet. We took a 90-10 call. That guy said, I cannot put in more capital. 20% capital is not possible by me. Okay. We said, chalo, okay, we'll put 90%. Right? As long as the risk is by you. We took a 20% FLDG. Up to 20%, you bear the risk. Right? So an NBFC combination can be played around. But when you're playing with a bank, it's properly regulated, and it has to be a 80-20. Any other questions on?
How it is different from consortium?
No, consortium is where for a SME, see, first consortium is typically for a SME or a corporate, right? Where few lenders are coming together, and each one of them are doing their own assessment, and there is a one lead banker who is saying that, okay, the total working capital limit required is 50 crores. Okay, I am participating to the extent of 10 crores. And he would have his own charge, and he would have his own security, everything will be there. Then other lenders are coming in with their respective limits, right? Now each bank is responsible for their own limits, right? Tomorrow if there is an issue also. Now as a joint consortium, they'll take a call on how to go about recovery and other aspects, but still each one of them have lent from their own books. Whereas in a co-lending, it is largely for the retail customer. It's not for MSMEs. Still it's not prevalent for MSMEs. It's largely for retail. It's for home loan, personal loan, and SMEs, right? To a large extent, small SMEs, right? Ticket sizes being 20 lakh, 50 lakh, that kind of size. Here, a bank lends 80% and the NBFC lends 20%. Now NBFC is fronting it. Bank may not even meet a customer, right? Bank person, whoever is there, the relationship manager, the field officer, he may not even meet the customer. Sir, see, from a RBI regulation, outsourcing guidelines, it says that how you are assessing your existing customer, exactly the same way you have to assess, which is what the regulation says. But when we outsource it to somebody, right, practically it is not possible, right? That's not what you would follow. Now, what they would do is instead, I assess the entity, NBFC, okay, and I trust the NBFC that they do the right things, right? While at an individual customer level, I'll take a call. I would have given the policies saying, okay, these are the 5 policies. If it's below, let's take the NBFC, might take a call, below 700 also I'll lend. They'll have different parameters to kind of look at it. Below 700 also they'll lend. But the bank will say, boss, below 700 customers, don't bring it to my books. You can lend it, but don't bring it to my books under our partnership. Right? So there will be 4 or 5 parameters like that, they would kind of put it, and so there is no relaxation. As per RBI policy, it says that you will have to treat it the same way as you treat your own customer. At the end of the day, it's your customer. 80% of the loan is in your books, bank books. So yeah. Any other questions around co-lending? Yep. So the comparison, the risk sharing, 2 or more lenders, single lender, share between lenders, borne by a lender, loan amount higher due to combined resources. See, this is one point. Now an NBFC, they'll have the distribution. For example, there is an NBFC based out of Hyderabad called ICAI Finance. Now ICAI Finance has good set of customers. They have a good set of customers. The customer keeps graduating, as in they would have borrowed 20 lakhs or 30 lakhs from that particular NBFC. Suddenly he graduates in his life. So he requires a 1 crore, 1.5 crore home loan. Now, why does the NBFC come to a bank partnership? Because they don't want to miss that customer. If they say that I don't lend 1.5 crores, now the customer wallet, they lose the customer wallet. Now they get into a banking partnership. Now they cannot lend a 1.5 crores for their risk pricing, their size, balance sheet size. That IKF Finance, who's let's take a 3,000 crore balance sheet, cannot lend a 1.5, 2 crores. Whereas they have a partnership with a bank like Central Bank of India and other banks, and they lend a 1.5 crores. So through this way, from a bank perspective, they get the distribution reach. Some of these customers who would have been permanent NBFC customer, now they're transitioning to the bank, and the NBFC is also not losing their relationship because the front ending is still done by the NBFC. Now it's a relationship, it's an understanding that while this is the point of outsourcing. Now a bank should have the right to call the customer if the delays are happening, but the way this agreement would be structured is that, boss, don't call up my customer. I'll ensure that money is being paid, or I'll pay it also. Right? NBFCs will act as a guarantor. These are again unsaid things. Right? It will not be in the regulation, it will not be in the paper, but there are certain things. The way it will be structured or implicitly understood is that don't call my customer. Right? If there is a collection issue, I'll ensure that your money gets paid on time. Right? Or at the end of 3 months, end of 6 months, during your audit period, whenever, if NPA exceeds a certain level, I'll take care. Right? So they don't want to lose their customers as well. Right? The moment these guys, bank call the customer, now they are losing the customer base, which is what they are trying to protect. Right? So this is how practically co-lending happens. Application process streamed with shared responsibilities, direct with one lender. Loan terms more favorable due to competition. Now again, when it's a combined thing, for a larger customer, and IKF Finance, the example I gave you, they will not be able to lend at a particular rate to the larger customer, 1.5 crore customer, right? Because they are an NBFC and they are borrowing at 12% or 13%. Whereas when they are in a partnership with the bank, 80% is funded by the bank. Now there will be a considerable rate of interest reduction, right? They have the customer, distribution is there, the customer is acquired, they will be able to lend to this customer at a far better rate because bank is involved. The other forms of NBFC financing, now these two products have been in the market for quite some time. It's been more than 15 to 20 years. One is called direct assignment, the other one is called pass-through certificates, right? Direct assignment is where NBFC originates a list of transactions, list of clients on its books, right? Once they originate a list of clients in its books, now I have taken, let's take a 50 crore book, 100 crore book I have built. Now I'll have to keep churning, I'll have to keep raising money to grow the book, no? So what do? Over a period of time, I try to undersell it, downsell it, right? Now the downselling process where I raise the money, now I kind of give it to a bank. I go and say, boss, this out of my 500 crores, you cherry pick what you want, right? You cherry pick the customers and I'll downsell it to you. So this is what is called as direct assignment. Now the risk is completely transferred. Again, what is theory, what is actual practice, I'll just come in a minute, right? As per theory, the risk is completely transferred to the bank. It becomes a bank customer. Now the NBFC acts as a liaison between the customer and the bank, and whatever is collected in the market, the NBFC has to pay back to the bank, is what theory is, right? Again, it does not happen that way in practice. What happens is that NBFC acts as a guarantor somewhere. See, I'll tell you, during COVID period, there was most of the microfinance entities had raised a significant amount of money through this method called direct assignment, right? The Manappuram ka subsidiary Ashirwad is there, and Belstar, lot of players were there. Now they've raised over 1,000 crores, 1,500 crores using this approach. Now when NPAs hit certain numbers, especially during COVID, NPAs hit 5 to 6%. Now what happens is this direct assignment product is lent only by few banks, Now it's a financing. At the end of the day, while theoretically it is a retail asset for the bank, it sits in the retail books of the bank. Practically how it happens is that a bank takes a call on the NBFC. Now, okay, who am I lending to? Whose book am I lending to? I'm lending to Ashirwad's books. I'm lending to Bellstar book. Okay, that NBFC, what is their rating? AA. Okay, I'm comfortable. I lend to that customer's books. Now, the quality of the underlying customer comes secondary. The quality of whose customers I'm lending to takes a primary stance here in a direct assignment, right? Now, hence, because I'm taking again NBFC as the priority and the quality of the customers comes one step behind. Now, when there is a problem in the portfolio, now the bank expects that the NBFC has to take care of it. So during that phase, actually practically what happened was that bank said, boss, somehow you kind of take care of this entire losses. We will not lend to you through both term loan or direct assignment or any other product if you don't make good of the losses. Because when a bank lends to this product, the understanding is that they are doing like more like a pseudo term loan. For all practicality, for RBI purpose, everything, it is a risk is completely transferred to the bank. But that's not how it happens in practice. So what is the advantage for the NBFC? One, it's a source of funding for them. Second, from a capitalization perspective, an NBFC needs to have a certain level of equity for a certain level of debt, right? They call it the capital adequacy ratio. Now that capital adequacy ratio, once the book is sold, let's take a 500 crore book, you had a 100 crore equity and 400 crore debt, right? Out of 400 crores, you have sold off your 100 crores, right? Which was financed through debt. Now you have 300 crores, so your debt equity ratio comes down, which your capital adequacy ratio, NBFC should maintain to the extent of 15%, that gets very well maintained, right? Your profitability is still intact, so it's more another mechanism of leverage to increase your profitability. The other product is called pass-through certificates. Pass-through certificates, again, pass-through certificates is a product where even, I mean, in a direct assignment, whatever is the rating of the, I mean, rating does not take a major factor here. The quality, okay, whatever the entity is, the customers, a bank lends based on it. Whereas in a pass-through certificate, you fund it based on, what do you say, you create something called as SPV, right? Special purpose vehicle. The entire pool is sold to that SPV, and you also do a credit enhancement on that SPV. What is the credit enhancement? You give more protection in terms of excess interest spread and other factors. Now, what is, let's take, if there is 100 rupees, okay, I've sold the 100 rupees, now there are certain collections need to come in. I'm also protecting, I'm giving an equity tranche. I'm saying that, okay, there is my participation as well to the extent of 10 rupees, my collection has to come. But first right is for you. If out of 100 rupees of customer, 90 is yours, 10 is mine, my customers pay also. Even if your customers don't pay, you are compensated, right? So the 10 rupees I'm taking the equity risk, and there is also excess interest spread. When I'm lending at 20% and your lending is at 10%, right? I have excess interest. That excess interest also comes as a support. Now hence, what happens is that even though the entity base rating, NBFC's base rating might be, let's take A rating. Now through credit enhancement, you may be able to make a A-rated pool, a AAA rated pool. Are you getting it? A-rated pool can be made a AAA rated pool with adequate enhancements. Enhancement is, you are protecting the cash flow. If 100 rupees is what is given to the customer is giving, and the customer can give 85 rupees or 90 rupees on a month-on-month basis, right? What has to come back, 10 rupees is always delayed. Now, when I am giving a guarantee, saying that, okay boss, I am also, my skin is also in the game. There is my collection of 10 rupees which has to come. My collection of 10 rupees has to come at 26% interest rate, and your collection has 10 has to come at 90 has to come at 10 rupees. So I have my excess interest is there. I have my principal which has to come back. Both this acts as a protection to you, right? Unless your entire 90 rupees is collected, I am not taking my money back. So with this protection, what I am giving, suddenly a A-rated pool becomes a AAA rated pool. Now the lenders are more comfortable lending to a AAA rated SPV compared to a normal direct assignment transaction. So this again, the rating is done by the credit rating agencies, and whenever it's a AAA or a AA rated pool, it is given more weightage, right? And the lenders are more happy to do it. This is more taken as a treasury product rather than investment. Rather than a retail book, this is invested by the treasuries of the bank. And historically, AAA defaults, whenever there is a pool of AAA, that has not defaulted too much, right? Or there has not been any default. I mean, securitization as a product in India has been existing for last 15 to 20 years. There has not been any default here. Whereas in microfinance, there has been certain defaults in the A rating and AA rating category. Even after the pool has been structured to be a AA rated pool, banks have lost some money in microfinance pools. Any questions around PTC? PTC is a product, again, it is at 75,000 to 1 lakh crore. All the three products, co-lending, direct assignment, securitization, all the three products are averaging around 70,000 to 1 lakh crore of funding for the NBFCs in the market today. These are the three large products which helps fund the NBFC. Any questions around these three products? ARCs does not come into picture here, right? This is NBFC funding, right? ARC is coming to the picture when there is a loss asset and then it has to be recovered. ARCs come into the picture then. That's right. See, ARC is on a distressed situation. Here the pool might be a healthy pool, right? The assets that you're downselling to a bank is a healthy pool. It's a cherry picked pool. ARC comes into a picture when there is a defaulted asset and bank is trying to get rid of it, and you have an asset as well which is backing it. ARCs come into the play. It's asset reconstruction company. Whereas here it is a highly qualified pool of assets. Let's take, I have given to 100 retail customers. I am telling the bank, you give your policy. Now the bank might say, give me only 800 plus CIBIL customers. Give me only customers in the last, if the 60 months is the tenor of the personal loan, you give me only customers who have paid 36 months properly every single EMI. You give me only those customers. So you are cherry picking based on the conditions that you like. Right? So you are picking a highly qualified pool here. So see, now the advantage for the bank is that while they are still trusting on the NBFC to do well, but tomorrow if anything goes wrong, for example, Diwan Housing went wrong, right? So as long as the asset is not fraudulent in nature, asset is true, and the retail asset is true, you are sure of that, then tomorrow a bank has a very widespread network. Bank can recover that asset. Right? When you are lending to an NBFC, it's very difficult. Directly lending to an NBFC as a term loan, it's difficult to recover. Whereas when you have lent to an NBFC or when you have in a relationship with an NBFC through a direct assignment or co-lending or securitization, at the end of the day, the retail customers, it's the retail customers whom you have lent to, and you have a strong recovery mechanism because the banks have deeper branches than even the NBFC themselves. Any questions here on the various modes of financing for NBFC? So comparison, co-lending is joint lending by the banks and NBFC fintechs. Direct assignment is pool is sold directly to the bank. Pass-through certificate is securitized and sold via SPV. See, again, this is PTC. I mean, if some of you are aware of 2008 crash, US market crash, some of this packaged mechanisms is what led to the crash at that point of time, right? But Indian market is highly regulated, and it's not bad assets which is packaged. Right, at that point in 2008 in US, they called it the CDO, right? Credit default options, CDO Square. They came up with very innovative products. Indian market, RBI, the regulator does not allow such innovative products. But even PTC as a product is limited in nature. About 60-70,000 crores is what is being funded, and these are funded for some of the top-notch NBFCs only. The retail assets, the bad retail assets, can still never be packaged and sold. Right, so loans are securitized and sold via SPV. Now risk sharing shared between lenders, direct assignment is fully transferred to the buyer theoretically. Now pass-through certificate shared among investors. Ownership of loan, joint ownership transferred, held by SPV. Capital relief, not immediate for the originator. Immediate for the originator means NBFC here. In a DA, the capital relief, the capital adequacy, what I was talking about, it's immediate for the NBFC in case of direct assignment because the loan is transferred off the books. Similarly in a PTC, PTC is a contentious thing, whether it's immediate or not immediate. There are certain cases where we have seen Big Fours have taken a call that PTC, it is not immediate because you are providing equity tranche, which means that you are still bearing a large part of that risk. Hence, the capital adequacy benefit should not be given, is what the view is. Target use case, real-time collaboration in loan origination, liquidity generation for NBFCs and investment diversification. Any questions around this subject? Sorry? No, it will be promoted by the NBFC and bank. NBFC. Any questions around this subject? Co-lending, direct assignment and PTC. I'm moving from the subject. This is one big change. I mean, next topic I had was budget, right? One of the biggest change in the budget, apart from the personal loan change, was the MSMEs. What is considered as micro, small, and medium enterprises, right? The numbers have significantly changed. Micro investment being 1 to 2.5, turnover changed from 5 to 10. So now a turnover of the entity being 500 crores can be considered as a medium entity. This is a significant change, right? Compared to, let's say, this started, I think, about 15 to 20 years back. At that point, a 50 crore entity was considered as medium, right? Now that number is considered, 500 is considered as medium. Now, why this change is important? Now, banks have something called as MSME cell, right? MSMEs are supposed to be, a bank has to take certain percentage of their assets in agri pool, in MSMEs. It's a push by RBI saying that, RBI and ministry saying that, okay, this number has to be there, right? So when a 500 crore entity comes into the bucket saying, okay, as a medium entity, they also get the privileges. They also can kind of, in terms of unsecured or some of the schemes of the bank. So it gets promoted for up to 500 crore entities. Starting from the smallest entity up to 500 crore entity, it is considered on the MSME bracket. So far, even you cross the 250 crores, you lose that benefit. Now with this promotion, things will be far better. Some of the scheme which are available in the market, these are some of the government schemes which are available. One is Anil Ambedkar Business Champions scheme. This is for a specific community of entrepreneurs, SC/ST entrepreneurs, and there is a upfront subsidy of 35% in this scheme, and up to 1.5 crores. And this basis various things. See, at the end of the day, the loan will still come at 10% rate of interest, but basis various this 35% subsidy and other factors, all in weightage, all in, it can be projected as a 6% rate of interest loan. So again, if the project is genuine and it's from a certain community, it can be still pushed to the bank, and banks are eager to fund this, right? Even personally, I have done a couple of transactions under this scheme. Banks and banks are open towards schemes as long as it is having approval from the district collectorate, right? And that district collectorate also, as long as the project is genuine, the collector office is willing to fund those projects. I have not seen projects getting unnecessarily delayed. You know the right channels to move through. Collector office okays the application, and the banks are more than happy, because again, banks have a target to give specific amounts or specific, under each of the scheme, they are supposed to approve certain transactions, right? So Anil Ambedkar scheme is one. Credit guarantee scheme. So this is a scheme which is very, very popular, and up to earlier up to 5 crores was given. Now that scheme has been increased to 10 crores. So even a 50 crore entity, if you have the proper justification, you can get up to 10 crores in an unsecured manner. Now what happens is that bank typically on the first time they take a call for a slightly lower limit. You go as a 20 crore entity, they might take 2 crores, 3 crores, 4 crores, and then over a period of time they can considerably increase that limit, right? So credit guarantee scheme, here again varying from bank to bank. What practically I've seen is that public sector banks are more amenable to CGTMSE schemes, because at the end of the day, government has given the directive to push certain schemes, while private sector banks also has this scheme, but they'll kind of challenge you, question you to grant under the scheme. They'll push through collaterals, or they need a very strong financials to sanction through CGTMSE. If your ITR does not support, they'll not sanction under CGTMSE. They'll say ITR does not support, give me collateral. Whereas a public sector bank bases the projections and basis other parameters, they'll sanction under CGTMSE. right? So because at the end of the day, the directive is from the government to the PSU bank. A private bank can never be questioned as to how much did you sanction, right, under this scheme. So I've seen more forthcoming. I mean, public sector banks are more forthcoming towards the bank schemes. Again, this is unsecured in nature, and this is far better compared to any of the other unsecured options which we have discussed so far. Now, be it a supply chain lending or the unsecured business loan, all the products that we have spoken so far, that comes at a very hefty interest rate, that comes anywhere between 18 to 20%, which again unnecessarily puts a pressure on the promoter to repay, and cash flow is significantly hit. Whereas this, I've seen banks lending even at 10% for CGT MSE, 10 to 11%. 10% can be done as long as the financials are healthy, and there is a guarantee fee of anywhere between 0.4% to 1.3%, which has to be given to the government for guaranteeing it, right? It's an annual recurring fee. Any sector they're happy to give, sir. Again, this is a product, as I told you, if there are branch level targets. If the branch level targets are met, they'll not show interest towards this product. But overall, if the financials are there and it's a profitable entity, the entity does not have a working capital, then getting under the CGT MSE is not a big challenge, right? You'll be able to get a loan as long as the justification is there why you are getting for it. If it's a 10 crore entity, you don't have any other working capital limit, you want a 2 crore working capital limit, you can get it. Or you want to procure machinery, you want a 3 crore machinery and you have a quotation for that, you can get a 3 crore, right? But you already have a 2 crore limit, working capital limit, you need another additional 2 crore, bank cannot fund this under this scheme, right? So, yeah. The other schemes again, Stand Up India scheme, which is again a loan. Here there is, if I'm not wrong, there is a 10% subsidy, and the loan amount given is about 10 lakh to 1 crore. This is specifically for women, again SC, ST entrepreneurs. The scheme is given to them. There are other schemes, Pradhan Mantri Mudra Yojana, PMMY, typically called as Mudra scheme, and there is PMEGP. Right, even these schemes, PMMY was increased from 10 lakhs to 20 lakhs in the recent this thing, and PMEGP up to 50 lakhs they give. Yeah, these are largely some of the schemes which are available, and at least my sense is that at least about in Tamil Nadu, around CGT MSE is one large chunk, a very large amount gets disbursed through CGT MSE. Other products as well, thousands of crores gets disbursed on every year basis, right? Anywhere from 10 lakh to there is one scheme which I have missed out, which is NEET scheme, a new entrepreneur development scheme, which up to 5 crores, it's a Tamil Nadu based scheme, right? Up to 5 crores unsecured loan can be, no, up to 2 crores unsecured can be given, about 2 crores you need still security. So these are the various schemes, and anywhere between 500 to 5,000 crores is what is getting disbursed in each of these products. Any questions around schemes? Okay, last section I had is about fintechs, right? Different fintechs which are there in the market. Again, sorry for juggling between bank schemes and fintechs and things. These are things I've both been on the fintech side as well as on the proper traditional banking side. So hence I thought I'll present everything this thing. So now the different fintechs which are available are one is the lending fintech. On lending fintech, one is the consumer lending fintech. Consumer lending fintech is the traditionally, I mean, the what we call the apps, right? Now these guys lend anywhere between starting from 14%, they go as high as 30%, 35%. In fact, if you calculate the IRRs in the traditional sense, some of these apps beat the money lenders as well. Some of the NBFC based apps also, I don't want to take names here in this forum, but there have been 15-day, 20-day kind of tenor products, and upfront they'll direct 10%. and these are RBI regulated entities. Right? So if you calculate IRR in the traditional sense, it will exceed 100%. Right? So there are products like this. In fact, one of those entities during COVID, I thought, okay, it will go bust. But during COVID also, it was profitable just because of the fact that they lent at significantly higher interest rate. Right? So anywhere between 14% to 30, 40, 50% is what they lend at. Again, RBI does not have a cap on the lending rate, hence they kind of play on that this thing. Yeah, now the assessment method is not traditional in nature. Now the lenders can assess based on various other factors, including reading your SMSs and other factors. There are multiple variables they kind of utilize, including your social profile and other factors other than the traditional things, how you behave with them on every cycle matters, just like the way traditional banks behave. Now they'll give you, let's take a 10,000 rupees on the first cycle, then once you keep paying them, they'll give you 25,000, 50,000, right? So that's how the consumer lending apps lend. There are certain entities which have scaled up pretty well, likes of Crazy Bee, Early Salary. These guys have scaled up 5,000 crores, 10,000 crores they have come to, right? There have been certain entities in the BNPL category, which is buy now pay later category. That was a very hot segment about 2 years back, but that segment has kind of bit the dust, right? There was one entity called Zest, right, which had taken over 2,000, 3,000 crore funding from various private equity players and VC investors. That entity kind of got sold for fire sale, right? It got sold for 1/10 or 1/20th of the actual price, this money, right? So various products in the market amongst the consumer versus MSME lending fintech, right? Consumer lending fintech, probably because of price or whatever reason, consumer lending fintechs has been surviving and scaling, whereas MSME lending fintechs, right, now the challenge is that a lot of players have tried doing various parts of the lending they have tried to do through fintech, from sourcing through to assessment to collection. Now what people have realized is that is possible, quite possible in consumer lending. When you are lending for 10,000 rupees, 1 lakh rupees, you are able to assess a lot of parameters and lend to a customer and still collect from the customer also. Everything digitized you are able to do in consumer, and that segment is scaling. Whereas in case of MSME lending fintech, quite a few players had come up and lot of players are under stress, right? Lending Cart got acquired by Fullerton. They got had to do a fire sale. They were not able to, whatever amount they had raised, the valuation with which they got sold about a year back was not even commensurate, right? And then I was reading the news article today that Kinara, that they were another fintech. They are under significant stress, and there is another entity called Flexi Loan. They are doing okay. So a lot of entities are under little bit of trouble, and scaling this is still a challenge, right? Not too many entities have kind of scaled to a significant level and proven that MSME lending is quite possible, because at the customer level, what still I realize is that sourcing is not digitized, right? It's a broken system. Customers, India is a low trust market, right? Especially in SME. See, personal loan 10,000, 20,000, people are through the digitized method, people are taking loan, that's fine. But when it comes to MSME, what do you say? There are still various nuances to lending. Hence, the touch and feel is very important, and sourcing of the customer also, large portion of it, 80-90% of it, it's still DSA for the MSMEs, right? For the NBFCs. So there is a large portion which goes out on sourcing cost itself. They are not able to directly do it with the customer, directly interact with the customer. Even the repeat cycle. See, in a bank, when I kind of work with the customer and the first loan I get it, the second loan the customer directly goes to the bank, because there is a bank and client relationship established, right? Whereas in a MSME scenario, when the turnover of the customer is 1 crore or 2 crore, now nobody knows the customer better than the DSA. So that cost bank is not able, NBFC is not able to kind of cut away. So the distribution cost is still persists, and that the sourcing part is still a non-digitized form. Now from an assessment perspective, it is still the traditional methods, while they try to induce a lot of other factors, but whatever the traditional parameters are, how is your bank transactions performing, and what are the things which are coming in, going out, what is your check bounces, and what is your CIBIL score, credit score, these are the factors. While these NBFCs might promote that, okay, I assess based on 1000 parameters, 800 parameters, 500 parameters, but 90% of the weightage is still given to the traditional parameters only. How a bank lends, these guys lend, do it. Collections, again, it has to be still manual based only, right? 70-80% of the collections get automatic, but the 20% of the customers who don't pay, now you'll have to have a physical mechanism to collect. So the chain is still pretty much broken, and the costs are significantly higher, and hence the unit economics, these guys have not been, the MSME lending fintechs have not been able to find a proper sweet unit economics which will make them significantly profitable. While they have been operating anywhere between 20% to 30%, still when things go bad, they are kind of, they end into loss making state. Because they borrow from the market at 15 to 16%. Some of these lenders, I know, I had personally lent to them at 14-15%, and their operational cost is anywhere like 8-9%, and the loss in this segment is around 5%, right? The NPAs hit a 5% in this segment. So even at a 25-26% rate of interest, they are not profitable, and they are facing a lot of stress. So while 3 years, 4 years back, this segment raised a lot of money, and there was a lot of noise around this segment. Now things are, I mean, this segment is under a lot of pressure. There are certain entities called revenue-based financing, right? Now, revenue-based financing, in fact, I was quite surprised to see what revenue-based financing was. There are 3 or 4 entities which are doing that. Now, revenue-based financing, by principle, they are ultimately doing what the private financiers are doing, right? They are saying, okay, if you have certain amount of revenue, you take it, and month on month you pay. If your revenue accelerates, you pay me in an accelerated manner, right? And you'll have to end up paying by 7th month or 8th month. If you calculate the IRR, again, IRR sounds to be very obscene, right? It works out to 40%, 50% kind of IRR, but it's very well packaged, right? And entrepreneurs who are not able to get it through other schemes, they end up with these revenue-based financing methods. Again, other fintechs being B2B payment gateways. Razorpay has scaled a lot. Cash Free, Pine Labs, and there is this one of the Tier 2 based promoter called IppoPay, right? Payment gateway has done quite well. Infrastructure fintech, in fact, my last entity where I was working with UB, they have provided infrastructure for the banks, right? Products including co-lending and PTC and other products. They're acting as an intermediary between a bank and the NBFC. They are a platform between 2 players, right? And they make a living out of it. So these are the various type of fintechs which I'm aware of, and some of the challenges, P2P lending crisis, right? Again, this is one factor which I will always keep telling. Now Faircent and other players were pretty active till about a year back. Now that there are issues around this product, this P2P lending crisis or invoice discounting platforms. There were a couple of invoice discounting platforms which were sourcing money from the direct retail investors. You would have seen there's one player, Falcon, which you would have seen in the news articles recently. They were promising 24% return to the investors, right? And what they were listing was, they were listing top rated entities ka bills, right? Let's take Hyundai ka bill and some large entities ka bill, and they were promoting that they'll give 24%, and they were giving it for a couple of years. Right, this is the usual, the old chit fund schemes and other frauds which used to happen 10 years back, 20 years back. It's coming back in a new form, right? As an invoice discounting platform. Falcon is under, I mean, you read the news articles on Google. Falcon is shut down, right? And they were promising 24%. And people, unfortunately, what happens is that I mean, even with years passing, whatever my father, grandfather, the mistakes they used to do, people continue to do that, right? Greed never stops, right? So these platforms, people have put in significant money, some of their lifetime savings, and they have lost the money. Right? So what I keep telling my friends, at least the close friends, is that whatever is not regulated, not seen the test of the time, even if it is regulated, if it has not seen the test of the time as an investment avenue, please don't go into a new fintech product. Right? How RBI will probably come late into the picture. After, let's take any of the product. See, this P2P, I used to keep telling my friends, even though they were giving 14%, 15%. Now, RBI will wait once they consolidate all the problems, after they see something scale and the scale related problems come in, then the regulator comes in. The Tamil படத்துல சொல்ற மாதிரி போலீஸ் கடைசியா வர மாதிரி இவங்களும் வருவாங்க. So as a investor we need to be very very cautious. Better to invest in things which are scaled, either equity at one extreme which are scaled, Nifty and BSE, or stick to let's take a mutual fund, debt mutual fund, or a FD kind of product. So there are things which are not scaled. Those are things which are coming in the form of fintech. How things will be in the next 2 years, 3 years, 5 years, nobody knows, right? These guys are all experimenting. The experimentation phase, if you are taking money, that's okay, right? I mean, we are borrowing. Let's take one of your SME client wants to borrow, and they are borrowing from a lending cart or a MSME or Kinara. That's okay. I mean, if that's a need, they have to borrow. But if you are investing into a company which is a new concept, better not to invest, right? Even if it is regulated by RBI. Yeah, that's largely what I had. And this is my team. We have a 20-member team with offices in 6 different locations. Thank you. Any questions? Happy to take.